In Manish Jain from Centrum joining us to discuss market fundamentals, top sectoral picks, and take this conversation ahead as well. Manish, good morning. Thank you so much for joining in. Well, of course, we have been talking about this big Fed event, the possibility of a rate cut today, finally, after so many months of being on either side. But, markets usually haven't reacted so much before or after in last couple of months. Do you think this could be the next big trigger for markets, or we've already priced in a lot of it?
I think it's by and large priced in. I don't think the market is going to be surprised by a 25 basis point kind of a rate cut today. I think cumulatively the market is already building in at least 2 rate cuts in the remaining part of this current calendar year. I think what could potentially be is going to be a risk from India's market perspective, given the way the monsoons have panned out in the last, especially a month or so. I think the harvesting season actually might not be as good as what most people are expecting it to be. And from that perspective, there are 2 risks to the Indian market, actually. Number one, basically being that food inflation might spike up in the next couple of months back again, which basically means that RBI might still be forced to pause rather than cut. And second is that the rural recovery, which has been a hope trade for almost a couple of years now, might actually get delayed even further. So those are the couple of risk factors, in fact, that I'm going to be looking forward to. But purely from a Fed rate cut perspective, 25 basis points, no surprise at all.
Okay. This harvesting season may not being as good as what everyone was hoping for, and it impacting food inflation. Have you spoken to companies? Is there any way to quantify the impact? Are you going to change your portfolio, align it to this narrative or emerging reality?
So, see, there are a couple of things that you need to notice over here. One is that in the last 3 or 4 years, sector rotation has been very, very intense. And I think everybody this current calendar year has been focusing on IT and FMCG, right? They've all gone, kind of been cutting weight or maintaining positions in banks, and they've all been increasing weight on IT and FMCG. And that's why you see the performance in the way it is. Now, IT is still okay. But FMCG is a very tricky thing at this moment, because what we at least notice is the fact that consensus earnings growth from Nifty's perspective is closer to 14% for FY25. Given the way the first quarter results have been, if the monsoons do not play out and if the earnings recovery does not happen in the second half, then you could very well be looking at 4, maybe 5% kind of earnings cut in the next couple of quarters from Nifty's perspective, and that's not really a great news. I don't think too many people are building in. I'll be very happy if Nifty delivers even 10% earnings growth this year, forget 14 by a very wide margin. So that's really the risk I'm talking about. And in that context, I think what we are trying to do at this moment is to be more bottom-up driven, be a little more sector agnostic. We've kind of included a couple of new bets on the NBFC space. We are looking at IT as another sectoral bet, which can be good, and then kind of tilt the portfolio more towards value rather than growth at this juncture.
Okay, so where are you finding value right now, Manish? You said some NBFC names that you like. Is there anything else where you are finding more value than before?
Like I said, it's purely bottom-up driven approach that we have, because a good point is that in the last 15, 16 months, the rally has not really been homogeneous. So there still are a number of bets that, we can still look at. In hospitals, for example, is one sector that comes to my mind. They've picked up one new bet over there. IT is again another sector that comes to my mind, where we've kind of picked up a couple of bets over there. NBFCs, again, we have kind of included a couple of them. For the first time in 5-6 years now, we've bitten the bullet as far as metals are concerned. So we've kind of had one bet over there. So we've kind of had 5 or 6 new ideas coming into the portfolio, but still maintaining the beta of the overall portfolio at 0.8, 0.85x or thereabouts, not looking at anything aggressive, looking at companies that are low debt, less than 1 times debt to equity purely, at least have 20% plus sort of an ROE. I think that's a bent of the portfolio we are kind of going ahead with.
So just getting back to, sticking with the weaker monsoon, theme that we've seen in the last 1 month, would you also be cautious on two-wheelers, tractor makers? What about some of these agri stocks, fertilizer-related stocks or agri-chemical stocks?
So fertilizers and agri-chemicals is not something that we really play in a big manner, but autos is something that we had been playing for the last 6-7 months, and we've kind of done fairly decently well on that. And that's something which we are now starting to look at in terms of the rally by and large being done, because anyways, autos is expensive. What we've gathered from the market and what our channel checks are telling us is that the retail sales has not really been as good as the company dispatches is, which basically means that the inventory in the system as far as dealers are concerned is actually fairly high. And then valuations, right? When you look at individually, especially in the four-wheeler space and a couple of frontline two-wheeler names as well, they have done phenomenally well in the last 1.5 years. So the valuations are not exactly cheap. So when you look at a sector like auto, I think definitely the room for error is very limited, very little. Wouldn't really be going gung-ho on that at this moment.
Okay, so not very positive on the auto space as well. I know you don't play agrochemicals and fertilizers in a big way, but anything on specialty chemicals, that entire pack is buzzing today. Do you think the recovery that these companies spoke of is something that you can play on from here on?
Yeah, that's something that we've been picking on, specialty chemicals, at least for the last 6 months. I think we picked it up at the right time where our view was very simple, which was that the sector had been underperforming for a couple of years now. There was going to be a recovery. There was going to be a turnaround at some point of time or the other. It was a matter of time. And we were kind of mentally prepared to wait out for it. We were going to wait out for it from a couple of years perspective. So we had 3 names that we had picked up in our portfolio in different capacities, in different weights, especially in the mid and the small cap space over there. And that's something that we are going to continue to hold on to for at least 1 more year. So that's a space which we are definitely 100% focusing on.
Just one quick question. I remember from our last conversation, the NBFC stock that you recently added was in the affordable housing space. Is that correct?
Yeah.
Okay. So now you've got a giant in the housing finance space, Bajaj Housing Finance. So have you looked at it? Did you participate in the anchor book, or would you be interested in buying it at current levels? And would you still, between affordable and the prime segment, which one would you, move towards, tilt towards?
Yeah, so the thing is that NBFCs, we are looking to play it from 2 perspectives. One is there are certain NBFCs in the affordable housing space which still look very attractive to us. That is something that we continue to hold on to. And that's something that we are kind of looking at least from the next 1.5 years perspective. And there's no change in heart in that. In the IPO, we did not participate. Typically, in a structure like ours, which is DPMS and equity advisory, it tends to become a little difficult given the number of clients that we manage. But at a certain price point, which is correct risk reward, we can definitely look at more ideas in the BFI space. We are definitely underweight over there. So there's no change of heart over there. And then there are certain smaller NBFCs, especially in the small cap space as well, where we again looking at very constructively. So this is a space which continues to remain of interest to us, 100%.
Okay, all right. Manish, thank you so much for joining us today with those market views and the sectors that you're betting on as well right now. Time for a short break now. Atul Agrawal, Managing Director of Sterling Tools, will join in next to discuss the company's growth outlook and a lot more. Stay tuned.